All right. Good evening. Good evening, actually. Today is Thursday, February 8th. I am recording this after the market close on Thursday. I will be out and about busy tomorrow, so I don't think I have time to do this video tomorrow. So it was today or not at all. And I don't know. I guess anything could happen in one day, but it seems like unlikely for anything drastic to happen tomorrow. So this is your weekly take on the market. I'll be your host. My name is Scott St. Clair. I'm the manager of the premium product group here at Investors Business Daily. Please take a moment to read the disclaimer. The disclaimer is very important. We are bound by compliance. I'm not licensed. Can't tell you what to buy, sell, hold, but we are allowed to invest in stocks. It's one of the great perks, for lack of a better word, of working here. And so I don't ever want that to change. I am very vested. I've been trading stocks for, gosh, the math sometimes gets away from me. 28 years. It's incredible. So definitely really enjoy the intellectual game of the markets. So, but I'm not licensed. Any stock that comes up, if I have a position, I will definitely disclose it, but it's not buy, sell, hold recommendations. And if you guys watch IBD Live, we go through this as well every single time. It's I know it's important. So okay, so market thoughts. I have a few slides I'll go through. I didn't do this last week. Arnie and Harold did their event, which was very good. And so it gives me, once a month I get a little break. And so it's been a couple of weeks. Oops. So, and then stocks to watch, et cetera, et cetera. So, jump right in because I think I have a lot this week. I think every time I go 2 weeks, it seems like I have quite a few thoughts. Anyhow, I like this chart. Thought it was interesting. The fourth year of a new president tends to see most of the gains later in the year. So if we follow this cycle, the market, and so far it has, right? It's been a pretty strong January, okay February so far, very early in February, but we should have some type of correction into the summer, and then you get a rally into the practically the whole rest of the year. So it wouldn't bother me if this was the case. I'm not going to trade based on this. Mike Webster always says, I think Mike Webster had a great tweet where he said he listed things that Bill never talked about, and two things that he mentioned that we talk about once in a while. Breadth is poor. I don't really think it's all that poor. If you need to own 8 to 12 to 15 stocks, there's plenty of opportunity. But for the larger funds, there's not a lot of breadth. The Russell is not performing at all, so I get it. I understand why they're saying that. And cycles, he didn't ever talk too much, if ever, about cycles, but they exist. And so it's I'd rather have a potential tailwind than a headwind, and it's just kind of interesting to think about. Uh, this is really good. Two things I love about this. Let's go backwards. Look at that kind of cup with handle, that this ratio. This is the S&P 500 versus the MSCI World Index. The Mad King, credit to him on Twitter as to where I got the screenshot. And you have like this cup with handle from 2001 to 2012, and then a little handle and a breakout in 2013, 2014. And it's why we look at charts, right? What did that tell you? That was a great time to be overweight US or ignore international pretty much completely. And it's been a really strong trend. Does that mean it has to end? No. It probably looked extended to a lot of people at one spot 3, at one spot 4, and now at one spot 5. But we're stretched and extended, two words that we hear a lot, and just be cognizant of that fact. But I love that little breakout. I wish I had seen this chart in 2013. I don't know how much that would change how I would have invested, but maybe it would have gotten me to, leave the exposure on the international side so much and just focus completely on US stocks. Possible. Maybe not. I do remember I bought my house in late 1998. I moved in 1999. And I remember a friend of mine at the office where I worked, he heard I was buying a house and he says, "Oh man, you're such a great time to buy a house." Now, I thought that it wasn't a good time because house prices had gone up for a few years. And I went to the community I live in, had an auction marketplace, and I waited in a huge line just to get a number. And then every time I would go to the release to buy a house, I just couldn't get called. I was way behind on the number. And everything felt like, that it's not a great time, right? To be a buyer. It's a seller's market. Is a new home. And so the builder, had us, they could release just a few homes slowly. Then the next phase, they'd go up $10,000, which doesn't seem like a lot now for homes. But in 1995, that was a lot. And so, but he showed me a chart, and I apologize. I was reminiscing about that whole thing. And he showed me a chart of home prices, and they were breaking out of a really big cup with handle. And it was comforting to me at the time. I remember thinking, okay, good. This, I'm making a big purchase. I'm going to take a lot of money out of my stock account to do so. And it felt like I was doing the right thing. And and in the end, you have to have a place to live. So it was the right thing either way, whether houses went up or not. But it just felt very like, even though I felt like I was not going to get much of a bargain, the timing was good. And so that's what this chart reminds me of. All right. No wonder these videos turn out so long. I can't keep them short and sweet sometimes. Maybe we need to develop like a little tool where you can play it on 1 1/4 or 1.5 times speed. Okay. Very interesting chart. Mayhem for markets. I get a lot of this stuff from Twitter. And Twitter has a lot of problems, but there are some really good people that share a lot of cool information. And net positioning from Nomura by asset managers is through the roof. U.S. equity futures positioning. Again, does that mean you want to go run out and short it? No, because it could keep going and going and going. But if you've been in this game at all a long time, and you're or even a medium amount of time, you can feel that things are really, really good. And you should know that they're not always this good. It's not always the NVIDIAs, SMCIs of the world. I think they go on a lot longer than people think. So it could go on a lot longer than people think, but it doesn't go on forever. So it just feels like the sentiment, the one side of the boat is pretty heavy, and maybe a little shakeout is in store. If you have stocks you really love, you batten down the hatches. Maybe you get rid of or loosen up or trim or sell the ones that aren't doing as well or that you don't love as much. That if those broke, if they broke 5, 10, 15 points off the highs, you'd be inclined to sell them. Maybe you do some trimming in that regard. AAII sentiment survey. I don't know. It's not that bad. 49% bulls. It should be more bulls. The 1-year high is 52%. The bears are pretty low, 22.6%. But why should you be bearish here? Remember, these surveys work in conjunction with prices. So as the price goes up, the survey gets more and more bullish. And as the price goes down, the survey will eventually get more and more bearish. What is the the 1-year high for bearishness? November 1st of 2023. It'd be interesting. In fact, we'll pull this up. We'll pull up that on the chart. We pull up the indexes. It'd be interesting to see what the market look like at that time. So, and I just build. I'm a mess. So, anyways, sentiment is, and rightfully so. People are making money. They get excited about it. It's fun when stocks are going up. But when you're long, I think Mark Minervini had a great tweet today. When I'm long, I'm looking for reasons not to be long, and when I'm out, I'm looking for reasons to be in. That's a good thought process to have. All right, so let's pull up the indexes. Here's the NASDAQ, and there's nothing wrong with that. It's acting just fine. I guess if you want to argue that it's too high or extended, it's just not a game that I like to get into. I can tell you, I kind of felt like it'd pull back here. I felt like we'd really get a pullback there. Felt like we'd get a pullback there. Was certain we'd get a pullback there. And so, investing how I feel is not gonna work. Not gonna like the results. I'll tell you that from experience. But we're almost 15% above the 200-day. We're 5.5% above the 50-day. So it's the index is pretty stretched. Let's go to the S&P. Again, looks just fine. 12% above the 200-day, 5% above the 50-day. This is kind of your guardrail, this line. I always like to see how the market reacts to that line. You can see when we were in a downtrend, tried to go above the line, failed. Tried to go above the line, couldn't even get above it, failed. But then when it finally got above it, it stayed above it, stayed above it. And we haven't even visited. I mean, in this rally, I'm just thinking about just now, we haven't even visited the 50-day a single time just yet. So this, after the start of a rally, you're almost always going to get a couple of visits to the 50-day that work. And so, maybe there's more runway than we think. Interesting. So November 1st, 2023, that's when I wanted to pull up. Oh my gosh. Wow. All right. Kind of like what I thought, right? So we're going down. Price creates the sentiment, the 5-year high in bearishness right there. Sentiment works really good this way. It doesn't work so good the other way. If there's too many bulls, the market can keep going. There's too many bears, too many reasons to be bearish, you're usually very close. In combination, that extreme bearishness in combination with a follow-through day, that's great fuel for the fire for a really good rally, which this has turned out to be an incredible rally. The Russell, I mean, it had a good day today, but it's just not that great. Now, there's two schools of thought on the Russell, that it's such a laggard that if the market starts to sell off, it's just going to roll over because it's so bad. That's kind of that would be the normal school of thought. The other school of thought could be that the money just seems to slosh all around. And if they let these big tech stocks breathe for a little bit, go sideways, build bases, 15, 20, 25%, maybe the Russell goes up. Maybe the money moves in there. Wouldn't shock me. But the Russell, I think it was Ed Carson who said the Russell is packed with, and I apologize, I forgot to turn my camera off because I know I sometimes cover the chart when I have my camera on. But the Russell, I think, is packed with financials and banks. I think Ed Carson said that on IB Live. So, and this is just a lousy area. Just there's no growth. Seems to be single bank problem, every 6 months. Currently, it's NYCB. I am full disclosure short NYCB in a synthetic in an option play. And, here's KRE, the banking index, which, broke pretty badly and is having is no umph. So there are areas that are just not performing all that well, obviously. So the Russell, I don't know. I don't really pay much attention to it, to be honest with you. That's like I said, I don't even realize it was up today. The NASDAQ, the S&P, these are the straws that stir the drink if you're interested in indexes. I I watch them just because I know they're important, but my focus is three-legged stool, stocks I own, stocks I wish I owned, and just overall portfolio equity curve, stock, number go up. It's important. I think, if the market's going up and I'm not going up, there's a problem. And if the market's going down and I'm going up, maybe the market's not as bad as it looks. So in the end, that's what you're trying to do, is move the needle on your portfolio. So that's really, I'm constantly evaluating that. If the market's really strong, am I making progress today? If not, why? How come? Is it one stock that's hurting me, or one name, or are all the names down a little bit? And when you run a concentrated portfolio, the swings are going to be a little bit bigger. If you have 6, 8, 10 names, you're not going to be down. When the market's down 1%, you're probably going to be down 2 or 3, is my experience. But when the market's up 1%, you're going to be up 2 or 3 or 4 or 5 or more. Sometimes it can, if you catch a really good earnings report or something. So you have to understand that kind of accordion effect with your portfolio. So these are the indexes. Let's jump to the industry groups. And let's sort them. I think biotech is one. Oh, okay. So it was. Computer hardware is number 1. That's SMCI. What an incredible stock. Biotech is 2. It's just a little surprising to me with the number of stocks in there. But remember, our groups are price weighted, so we just put a lot more weight on the bigger leading stocks. Computer software security is a great group. CrowdStrike, Palo Alto, SentinelOne looks good. There's a lot of stuff there. Energy coal, moving down the food chain a little bit. Semiconductor fabless, that's who, the 800-pound gorilla. Nvidia, apparel, shoes, Deckers, computer software, financial. I don't know that group that as well as the others. Intuit, I'm guessing. Computer tech services, interesting. So 42, 7, 8. Household furniture, probably not interesting to me. Networking was 3 months ago, or 6 months ago, it was 74. 3 months ago, it's 25. Last week it was 11. Now it's 10. I like that kind of progression, and so on and so forth. So the groups are really good as far as the quality of types of names that we would be interested in. So I think the industry groups are more than fine, telling a good story. It's not like there's gold stocks, or maybe coal's a little bit different, but gold or managed care or something like that. Semis are, we didn't look at SMH, but I think SMH is just hit a like an all-time high. And it came out in 2000 and never been higher. Really, really strong group. One thing I love about semis is the depth of the group. There's almost always 1 or 2 or more names you can buy with earnings and sales and quality, price action, relative strength. And I have an affinity for semis because, and a lot of people do. A lot of people made their big score, or one of their big scores, in a semiconductor stock, like Jim Ropel. It was Broadcom, but C-Cube Microsystems in 1995 was the big one. It's no longer around. I don't remember how it got merged, but that was my first really big win and video compression semiconductor company. So I really like when there's quality in that group. Okay, so let's jump into the stocks, and we'll start with all the leaders. NVIDIA triggers the 8-week hold rule. There's some confusion on how to handle this. I think it's to each their own. It's not, I don't think Bill would say, if he was around, that you have to own a stock that triggers this rule, but he might. I would imagine that if he was around trading, he would still be in NVIDIA, and regardless of whether that rule got triggered or not, because of how big it is, the earnings, the sales, all of that. So if if that's what you're looking at, you have 8 weeks, and you are in week 5. So after 8 weeks, you reevaluate. Somewhere along the line, there's going to be a shakeout. It could come on the earnings in a couple of weeks. Maybe it goes climactic on the earnings, and you get that type of sell signal. But this is just math. That's what that power from pivot is doing. It doesn't matter how the quality of the stock. If it goes up 20% or more in 3 weeks or less out of a base that the algorithm sees, this gets triggered. And it's just more information for you to make a decision for yourself, right? That's the idea. Full disclosure, I do have NVIDIA. I do not have quite the position I once had, unfortunately. I tend to trim on the way up, and sometimes that hurts me, and sometimes that helps me. And in this case, for the NVIDIAs, SMCIs of the world, CrowdStrikes of the world, it's hurt me, obviously, because they just don't come back. SMCI, let's go to that one. So you got really powerful earnings gap. And these are, if you're not in SMCI or if you didn't trade it at all, I would say, then this is a good learning lesson. Like, you go back and study it. Yeah, it's not easy. I have to tell you, I bought this stock near the end of the day, up 30-some%. It's really difficult to buy a stock up 30% in one day. But that's why, have you ever heard the saying that, the good trades are the hard trades? I used to have a friend that would trade, and when he would buy a stock, if he got a good fill, let's say the stock was 100 by 100, and this is the days of when there was a spread, 100 by 150 cents. You have a 50-cent spread, and sometimes they trade in the middle. But if he'd give a market order, and let's say they gave him a fill of 101/8, he would immediately turn around and sell that stock. That's too good a fill. Why are they giving me stocks so close to the bid? He wanted that feedback of having, he'd prefer that he moved the stocks. If he bought 1,000 shares at a market, he'd prefer get a fill of 700 at 100.5 and 300 at 100.75. That would be good information to him. So when a stock does this, it's not easy, but that's not your Aunt Sally down the street doing that. There's big institutions have changed their models on this stock. And before they pre-announced, imagine the hedge funds, just let's play a scenario where all the hedge funds thought SMCI was a $400 stock. They just all had they all valued it based on some dividend discount model or whatever you want to call it, and they all had it at 400. Well, SMCI comes out and says, we're going to do X number of earnings and sales. And they plug that into their model. And now their model says SMCI is a $1,000 stock. And I'm just making these numbers up, obviously. Well, do you think they care if they pay 380, 390, 400, 410, 420, 430? No, their model says it's 1,000. So they'll just pay all the way up regardless and relentlessly. And that's kind of what's gone on here. That's why you get this relentless buying. Why, now for me, I buy it at 400 and 5 days later it's 500. I can't stand the pain of the gain, and I'm going to take some off. But the institutions, most of them, they're building their position. They're not going to do something like that because they haven't even gotten to their full position. Whereas I can get my full position, in a matter of minutes across a number of accounts. So good lesson. Now I waited till the end of the day. It was near the end of the day before I did this. I wanted it to actually close really strong. That was important to me. Sometimes they do. Was it CAT? I mean, it had a bit of a reversal. Lilly, was it Lilly? I mean, that kind of had a reversal, but I can't remember which stocks. But sometimes, they'll go up and then they'll reverse, or they'll close poorly on the day, and that's good information as well. So, off topic, but in this same vein, Powell, here's one that I own, and I knew nothing of Powell until it did this. It's up 45% in one day. Well, now it's on my radar, and I was really hoping that it would go sideways for a few days, but it didn't. And I had like a little trend line drawn, and it did this that day. So it was down, and then it closed up. So I was forced to buy it a lot sooner than I wanted. I really wanted to buy it more like that. But 45% in one day, something going on. It's a little thin, different, but same kind of thought process. Let's go to ARM, which announced today. So you can see, I mean, it's not a great close. The range is 61%, but gosh, it's such a huge move, up 47%, that I would give that the benefit of the doubt as far as the range. I'd prefer to close higher in the range, but when you go up 50%, it's not unusual for you to do this. So this looks, and probably for me, that I don't own ARM, but it would be more I'm like Powell, not Powell the Fed guy, but Powell the stock. I'm hoping it does something like that, and then I will take a shot on it when you get that kind of power. So that's how I would look for that. But it would be definite watch list stock. And I know SoftBank has a big position in it, and there's a lockup period coming. Good. Let's hope that lockup causes some trepidation and causes the stock to go sideways for a number of days to weeks. What else is there out there? Meta. And so Meta is a little different on the gap because Powell, the gap occurs where? After a long basing period. SMCI, after a long basing period. Meta, where does the gap occur? Well, I mean, this one's a little bit after a long basing period, but this one is, the stock has gone up. Let's pull it up on a weekly. I mean, is this a long basing period? So it's not quite the same. Now, I didn't own Meta and don't have a position. And it's probably going higher based on the price action. But to me, my tune would be a little different. If I happened to own that, I'd probably do some trimming, if not outright selling into that based on where it is in relation to the base. But acting great. On a related but side note, this is why we buy leaders. Here's Snap. Now, I know before the earnings on Snap, the stock looked okay. It was in a base. The relative strength was okay. It was, I don't want to miss. Well, let's look. Let's look and see what the relative strength was. Checklist. I'm sorry, not checklist. Technical. Well, 1 week ago was 96. So that's good enough information. But the earnings for Snap were not very good at all. Now, that doesn't mean they can't be good and the stock could go higher. That's possible. I don't have to have perfect earnings across the bottom. NVIDIA didn't when it started getting going. But it just didn't, to me, Meta's the leader. Snap is also Rand, or the second best company in that area. Could you make money on the second best? Sure, but you're always probably, anytime you have the choice between the leader and the second best company, find a way to get into the leader. That's what I think. So I know some people on IBD Live were saying, "Oh, is Snap a buy based on this?" And I was thinking, I flat out no. In fact, if you forced me to take a trade in Snap, I would have shorted that versus buy it. And you can see it was down again today. So food for thought. Try to focus on the leaders. Net, I think Cloudflare, gosh, had a really great day today. Up after hours, earnings up 150%, revenue up 32%. So this one was a little tricky, but bouncing off the 50-day. Great price action after hours. What else is out there? Apple is building a base. Very interesting. I can't wrap my head around this stock. I just don't trade Apple. I guess maybe the product, the Vision Pro, it could be something. And so maybe that's what the market sees. But the numbers are just so pedestrian. And the relative strength is 64. So just not something I would be interested in. Affirm, again, looked really good going into the print, down, I think it's around here after hours, around 40, 41, something like that. No earnings. Now the revenue is accelerating, but I don't know what they said, but technically the stock looked good, but not a great action or after hours so far, at least on the earnings. How about other leaders? So if the market's so thin, right, we hear that a lot. Well, you could own Chipotle, a restaurant stock. How about a shoe stock like Deckers? Could you own it here? No, I don't think so. I think it's late. You've missed it, but you could have owned it here. Oh, what did we talk about? Up 19% on earnings. Powell. Like, what else? VRT went up a bunch on earnings. They tend to trend when they come out of that, when they gap up out of that base, they tend to trend. You could have bought off the 50-day. This has been a good trading stock. I've missed the boat on that one, but here's VRT. The first time it showed up on my radar was up 14% out of that base. I knew nothing of VRT at that time, but anytime a stock can gap up on earnings and hold that gap, that's very interesting to me. Guess what? It did it again, up 30%. Now this one was a little bit extended, got a little tougher, but gosh, for those that imagine your institution, your model says the stock's worth 60. Remember I talked about that? You just buy at 30, you buy at 31, you buy at 32, you buy at 35, you buy at 36. And so far they've gotten it right. Those that have built that position like that. I think that's all the kind of names that I wanted to talk about. There are a lot of other names out there for sure, but for the sake of brevity, I'm going to leave it at that. Because, and I apologize, I might have this out of order a little bit, but I get a lot of questions about position sizing and building positions. So, and we have a lot of, there's 2 webinars on our website on just that position sizing. Now they're a little bit dated, and my thought process, at least for me, is, I don't want to say it's changed, but it's evolved. I think you always want to be evolving with the market. The market is always, it's very fungible. It's changing all the time. And you want to be able to be in sync with it as best you can. But there's a lot of ways to build a position. And with all apologies to Mark Minervini, I didn't include him in this deck. I wanted to, but I just thought, gosh, this is going to be a really long video. Mark Minervini talks about financing the trade. So let's say he buys 1,000 shares of XYZ at 100. It goes to 110. He sells 500 at 110. He's locked in $5,000 in profits. And now if the stock were to hit a stop at 95, and I'm just using these numbers, I would explore more, let Mark tell it. He'll tell it better than me. He's financed the trade. If his stop gets hit at 95, he'll lose $5,000 on that half, or actually less, right? He only has 500 shares, 2,500. But he took profits on, let's say he took 2,500 profits just to make the math easy, and he scratches the trade. And that's how he likes to trade. He likes to finance that risk, to peel off a little bit, let some run. That's one way you could do it. The way Jesse Livermore did it, and there's pros and cons to all of them. What were the pros to the way Jesse Livermore did it? Pedal to the metal. When he got it right, he got filthy rich. Making millions of dollars, hundreds of years ago, but over 100 years ago. I think from $1 million in his time might be probably 50 million now or something crazy. So, but he also went broke a couple of times. So I guess keep that in mind using his strategy. But he talks about the time he wanted to buy Bethlehem Steel. And he watched it go up. He was patient, and he had the ability to buy 500 shares that his broker had given him on credit. So he watched and watched, and then he was watching from another brokerage firm that wouldn't take an order. And so he says, I rushed to Williamson and Brown's. He watched, he says, it's going through 100. I got to have it. And so he went from one broker to the other, and he put in his order of 500 shares of Bethlehem Steel. The market was 98. I got 500 shares at 98 to 99. Interesting. What did I tell you about my friend? Exactly how he wanted to get filled. This is where he learned it from the book. After that, she shot right up and closed that night at 114 or 115. I bought 500 shares more. So he, pyramids his position, but with the same size, right? So he's really jamming his average cost. The next day, Bethlehem Steel was 145. I had my stake, but I earned it those 6 weeks of waiting. So he had a system of pyramiding, but there didn't seem to be any, and I would read Reminiscences of a Stock Operator for sure if you haven't, and he has a book. There was no method to the madness that I could, it was all it meant. One thing that happened is as long as the price was higher, he would add more. If he was shorting, the price was lower, then he could short more. He never averaged, that's for sure. He never averaged down long side, never averaged up on the short side. At least not when he was trading well, if I can recall the stories. So this is the way he would do it. And the pro is, man, if you get it right, you 500, 500, 500. It keeps, imagine if every time I bought SMCI, I still kept the other shares of SMCI. Sometimes I was like, I think about that, but there's just no risk plan in place for doing that. You're just going to get so top heavy, and it's going to put a lot of pressure on you. So that's the way Jesse Livermore would do it. I wouldn't do it this way. I like the fact that you can, if you get it right, you make big money when you're right. But I think there's a problem with the other side if you're wrong. So Nicholas Darvas, how did he do it? Different ways, but mostly, here's a screenshot of his trade in Universal Controls, I believe. So he bought 2,000 shares at 94 3/8. He bought 1,500 shares at 97 7/8 and 2,000 shares at 101 7/8. So, is there any kind of math to that? It didn't seem like that, right? So 3 on 94 is about 3%. And roughly 4 on 97 and change is about 4%. The one thing you'll notice for sure, the price is higher. He's buying on the way up. Always, always, always with Nicholas Darvas. 2,000, 1,500, 2,000. I don't know. And if you read the book, I would, How I Made $2 Million in the Market. There's some more screenshots of this. And it's kind of typical as far as the sizing. I think in Texas Instruments, he bought 1,000 as like a probe, and then it started to work, and then he went to his normal position size and bought like 1,700 shares or something like that. And I have done that on occasion, and we'll do that. Let's say I want 1,000 shares of XYZ. I might buy 200 shares, because it's not timely. but I want to have a position in it. I don't want to let it get away from me. What if it were to gap up on earnings or something like that? So I might buy 200 shares. And then if it really starts to show itself by going up, I might go and buy 800 shares. And, that's kind of extreme in that regard, but I will do that, buy more. Not quite like Nicholas Darvas would do it, a little bit more. So maybe I have 400 shares, I might buy 700. If I have 1,000 shares, I might buy 1,400 or something like that. So the advantage to this system, the pros and cons, the pros are, if I'm wrong on a smaller position because I've got this kind of probing position. If it goes down, I just get out and I don't on a smaller position. The disadvantage is, right, my average cost is higher than it would be normally if I just bought it all at my certain price. So that's the disadvantage of it. But this is a very good system for Darvas, and he did incredibly well using that type of approach. Bill O'Neill, how does he teach it? And Bill was a student of the markets. So he read Reminiscence of the Stock Operator probably 1,000,000 times, read Nicholas Darvas, studied these guys, and he kind of put it all into his own system. So if you want 1,000 shares of XYZ, he would say buy 500 at 100, buy 300 at 102.5. That's 2.5% above your pivot price or your action price, and then buy your last 200 shares at 105. This will allow you to have more lower cost stock initially. If you're wrong, hopefully you're wrong right away. You only get stopped on 500 shares, right? That's one of the advantages of doing it this way versus buying 1,000 at 100. And then the disadvantage is, well, you were right. You wish you had 1,000 at 100 so you could buy another 1,200 at 105 like Darvas might or Livermore might. So the pros and cons to this strategy as well. You're allowing the market to pull you in at ever higher prices, but you don't want to jam your average cost up too much, so you're buying with lesser shares each time. I don't quite do it exactly like this either, but something like that. I might buy 500 shares at 100, and if 300 shares, I just get antsy. I give the stocks benefit of the doubt. If it's 101, I'm probably buying 300 shares, and then it's 102.5, I'm probably buying my last 200 shares. So I tend to pyramid a little sooner than 5%, but again, always on the way up in price if I'm buying. I want that next purchase price on the long side to be higher, and if I'm shorting, it needs to be lower. Dan Zanger, I don't remember where I got this. I think somebody tweeted it, or maybe it was a Substack, but this was from Dan Zanger. He said, if I want to buy 200,000 shares of a stock like Google, I'll buy 70 to 100,000 shares and see how it reacts. I might wait an hour or two. That's all, and see how the stock is moving. Then as the stock continues to move up with heavy volume, it is not timid, making new highs, and I might add another 30 to 40,000 shares. So you get the idea. What do they all have in common? Adding on the way up, adding to your winners. We didn't talk about cutting the losses, but that's the other part, of course, too. All right, so I definitely talked about the stocks to watch already. Let's get into the quote of the week. It's about Ed Seykota. I think I might have used this quote before, so I apologize, but it's such a good quote. We're going to use it again. He says, when he looks at a market, everyone else thinks is exhausted its uptrend. Does that sound familiar? That's often when he likes to get in. I asked him how he made this determination. He said he puts the chart on the other side of the room. If it looked like it was going up, then he would buy it. Of course, this trade was seen through the eyes of someone with deep insight into market behavior. Ed Seykota has a tremendous track record. Somebody emailed me I showed that those returns, and Ed Seykota was like 60%-ish, and he said that was actually cherry picked for the worst. That was his worst performance range, and he purposely wanted that shown because he didn't want to make it look like he was, I don't know if it was he just didn't want people to get confused by, the market being difficult, whereas it seemed so easy for him based on his returns. So this market, a lot of people have talked about how this market's been too high. I think all of last year, everybody was looking for a recession and that the market had to stop going down, and it just keeps making higher highs, and it will end when it ends. And prepare yourself for that, have a plan in action. But so far, it's been a great market, and let's hope it continues. Knock on wood. Okay. I know it's a long video. I really appreciate your guys' patience and feedback. MarketSmith@investors.com, 800-424-9033. Again, it's Thursday night. So if you watch this video on the weekend or some other time, we don't have Friday, May 9th. I'm sorry, Friday, February 9th action. Have a good weekend, everybody. Enjoy the Super Bowl. I'm not going to say who I'm rooting for, but there's a certain team I want to win, and so but it should be fun. Let's hope it's a good game. That should be the best part. Bye, everyone.